Accounting for the tax effects of equity awards is some of the most complicated reporting that you will do for your stock plan. But in this video, I'm going to try to explain how it works in just about 10 minutes. Let's see if I can do it. Normally, expenses that companies report reduce the amount of tax that they have to pay. You can see here in my sample P&L or profits and loss statement that even though the company reported revenue of $3 million, they're only paying tax on the $500,000 of net income that they report for the period. But when it comes to equity compensation, it's a little bit trickier because the amount of expense that companies recognize for their equity awards is different than the tax deduction that they get for those awards. Tax deductions are determined by Congress, and the expense a company recognizes for its awards is determined by the Financial Accounting Standards Board. And those two sets of rules are completely different. There are two key ways that the expense a company recognizes for its equity awards differs from the tax deduction that it gets for those awards. The first is just in the amount. The expense that a company recognizes is based on the value of the arrangement at the time that it is granted. So here in my example, when we grant an award, it is worth $10 per share, and that's what our expense is going to be for that award. The tax deduction that a company gets is based on the amount of income that the employee has to pay tax on. That is determined at the time of settlement. So in this case, when the award is settled, it's worth $14 per share, and that will be the company's tax deduction for the award. The second difference is in timing. Once we've determined the expense for an award, it is recognized over the service period of that award, which is usually that period from grant until when the arrangement vests. But of course, tax deductions don't occur until the employee recognizes income, which is typically going to be at settlement. Now, if this is a full value award, settlement might occur on the vesting date. But if this is a stock option, it could be several years down the road after vesting that the settlement occurs. What I'm going to do is go through an example to illustrate how we account for those two differences in our P&L. We're going to start with a sample P&L that doesn't include any equity awards in it. Also in my sample P&L, I've skipped past sort of the revenue and the expenses section, and we're just going to look at the bottom line numbers. This company had pre-tax earnings of $1 million, which results in tax expense of $200,000. Now, how did I come up with that tax expense? I just took $1 million and multiplied it by my 20% corporate tax rate, which is what I'm assuming for purposes of this example. Now, a note on corporate tax rates. Right now, the U.S. corporate tax rate is 21%, but it is a lot easier to follow the math if we use a nice round number. So for purposes of this example, I'm going to assume a corporate tax rate of 20%. We deduct that tax expense from the company's earnings, and that gives the company after-tax earnings of $800,000. Now let's add in an equity award. So let's say this same company granted an RSU worth $100,000. And to keep things simple, let's say that the service period for that RSU exactly corresponds with the fiscal period of my P&L. So that whole $100,000 of expense is recognized in this one P&L statement. What's that going to do to the P&L? Well, the first thing that you'll notice is it reduces our pre-tax earnings from $1 million down to $900,000. But look what it does to the tax expense. That also gets reduced from $200,000 down to $180,000. That's because the company had fewer pre-tax earnings, which means less tax expense. Then the after-tax earnings is reduced to $720,000. So even though the RSU resulted in expense of $100,000, the actual impact on the company's net income is a reduction of only $80,000. In order to account for this RSU, the company is going to record expense of $100,000. Then they're also going to record something called a deferred tax asset of $20,000. That deferred tax asset represents the tax benefit that the company eventually expects to receive for the RSU. And I'm using the word expects a little bit loosely here, because in reality, the tax deduction or the tax benefit the company expects to see is probably completely different than $20,000. It'll be based on what the RSU is worth at the time that it's paid out, which is probably going to be totally different than the $100,000 it was worth at the time of grant. But for accounting purposes, when we're recording expense and recording the tax effects of those expense, we assume that the deferred tax asset is going to be based on the amount of expense recognized for the award, even though in reality, it probably won't be. And then that deferred tax asset is going to reduce our reported tax expense in our P&L for this period by $20,000. It is also important to know that all of this is happening only in the P&L. So we're going to reduce our tax expense in the P&L to $180,000 as a result of this RSU award. But when the company files its tax return at the end of the year, the check that it's going to write to the IRS is still going to be for $200,000 because the IRS does not care about that RSU award. It is not yet a tax deduction for the company. So it does not in any way affect the company's tax return, even though we're going to tell shareholders in our P&L that it did reduce our tax expense. When the award is eventually settled, we are going to have to reconcile the tax deduction that we told shareholders we were going to get in the P&L with the tax deduction that we actually get for the award. So let's say that the RSU is paid out when the award is worth $140,000. That's going to result in a tax deduction for the company of $140,000, which is $40,000 more than what we told shareholders it was going to be. So yay for us! We recorded a deferred tax asset of $20,000, but our tax benefit actually turned out to be $28,000. So the deferred tax asset that we recorded, that's already reduced the tax expense that we reported in our P&L. But that extra $8,000, we're going to record that in the period that the RSU is paid out. So in this period, we're going to show an additional reduction to tax expense of $8,000. Now let's consider a different scenario. In this scenario, the RSU is paid out when it is worth only $90,000. So this does not work out quite so well for us. We told our shareholders we were going to get a tax deduction of $100,000, but it turned out we only got a tax deduction of $90,000, $10,000 less than what we said we were going to get. We recorded a DTA of $20,000, but our tax benefit turns out to only be $18,000. That means that in the period that the RSU is paid out, we are not going to reduce tax expense even further. In fact, we're going to do the opposite. We're going to increase tax expense. We're going to report that we paid an additional $2,000 of taxes in this period to reconcile the shortfall that we've experienced with what we told shareholders we were going to get as a tax benefit for the RSU. So the rules that I just went through apply to non-qualified arrangements. I use the example of an RSU, but you'd use the same accounting for a non-qualified stock option or a stock appreciation right. For qualified arrangements like ISOs or qualified ESPPs, the rules are a little bit different. With qualified arrangements, you don't really know that the company is going to get a tax deduction. It will depend upon whether or not employees engage in disqualifying dispositions. Because of this, you do not get to assume a tax deduction up front when you are recording expense for the award. So you don't record any deferred tax assets for qualified arrangements. You also do not reduce tax expense for the arrangements as you record expense for them. So in my example, if that RSU had been an ISO, I would not have reduced tax expense. I still would have had $200,000 of tax expense, and the ISO would have been a dollar for dollar reduction of my net after tax expense. If, with the qualified arrangement, employees do eventually engage in disqualifying dispositions so that the company does realize a tax benefit, the company at that time can reduce their tax expense for the full amount of that tax benefit. So that is how you account for the tax effects of equity awards. I hope you enjoyed my video. If you did, please subscribe to our YouTube channel so that you are notified when we post new videos. Heck, even if you didn't enjoy it, subscribe anyway. Maybe you'll like the next one. Thanks for watching.